There is a good chance you have already turned this down. Not on purpose. You were sitting in an open enrollment meeting or clicking through your benefits portal late one night, only half paying attention, and someone described an account in a single, rushed sentence. It sounded like a thing for doctor bills. So you moved on, picked your dental plan, and closed the tab. That 10-second decision, the one you barely remember making, may have quietly cost you more money than almost anything else you do this year. Let me show you what I mean. Picture two people who work the same job for the same paycheck and who both get hit with an $11,000 hospital bill after insurance. Both of them pay it, but one pays with money the government never got a chance to tax. Not on the way in, not while it grew, not on the way back out. The other pays with money that had already lost close to a third of itself to income tax and payroll tax before it ever reached her checking account. One person effectively spent $11,000. The other spent closer to $16,000 for the identical surgery. The gap between them was not income. It was not a financial advisor or some private banking arrangement the rest of us can't reach. It came down to one ordinary account offered to both of them on the same afternoon in a meeting you have very likely sat through yourself. One person understood what it actually was. The other heard the phrase medical account, tuned out, and clicked decline. If that second person sounds a little like you, do not feel bad for a second. This account gets explained so poorly and framed so misleadingly that most people will work for 40 years and never once use it the way the quietly wealthy do. By the end of this video, that will not be you anymore. You are going to understand it better than the person who pitched it to you at work. So let me start with why something this valuable manages to stay this invisible. Picture your last open enrollment. Someone from HR or a benefits broker stands at the front of a room or talks over a slideshow on a video call. They have maybe 40 minutes to cover the medical plans, the dental plan, the vision plan, the life insurance, the 401k, and the deadline. When they reach the health savings account, they give it about 30 seconds. They say something like, and if you pick the high deductible plan, you also get an HSA, which is a tax-free account you can use for medical expenses. Then they move on. Next slide. Nothing in that sentence is a lie, but everything important is missing. What HR will not say, because it is not their job to say it, and most of them genuinely don't know, is that this is the single most tax-advantaged account the United States government allows a regular person to open. It is more tax-advantaged than your 401k. It is more tax-advantaged than a Roth IRA. There is no other account like it. And the reason it gets 30 seconds instead of 30 minutes is that the system treats it as a tool for paying doctor bills, when it is actually a tool for building tax-free wealth that you happen to be allowed to spend on doctor bills. The wealthy figured this out a long time ago. Financial advisors who work with high net worth clients have a nickname for the HSA. They call it the stealth IRA, or the secret retirement account. They max it out every single year, they never spend a dollar of it on a current medical bill, and they let it grow untouched for decades. Meanwhile, the average employee uses it like a debit card, drains it every December, and never discovers what it could have been. By the end of this video, you will understand the entire mechanism, the 7 specific moves that separate the people who build a 6-figure tax-free balance from the people who never get past a few $100s. The brand new rules that took effect in 2026 that just opened this account to millions of Americans who were locked out before. And the honest downsides, because there are real ones, and I am not going to pretend otherwise. Let's get into it. Secret number 1, the triple tax advantage. This is the foundation, and it is the part that almost nobody has explained to you properly. In the American tax system, money usually gets taxed at 3 different moments in its life. It gets taxed when you earn it. It gets taxed on any growth while it sits invested. And depending on the account, it can get taxed again when you pull it out to spend it. Every retirement account you have ever heard of is essentially a deal where the government agrees to skip 1 or 2 of those 3 taxes. Take a traditional 401k. The money goes in before income tax, which is great. It grows without being taxed each year. Also great. But when you withdraw it in retirement, every single dollar gets taxed as ordinary income. So a 401k skips 2 taxes and charges you the third. Take a Roth IRA. The money goes in after you have already paid income tax on it, so no break there. But it grows tax-free, and it comes out completely tax-free in retirement. So a Roth also skips 2 taxes, just a different 2. Now look at the health savings account. The money goes in before income tax, like a 401k. It grows year after year without being taxed, like both of them. And when you withdraw it to pay for a qualified medical expense, it comes out completely tax-free, like a Roth. That is all 3. Tax-deductible going in, tax-free growth in the middle, tax-free withdrawal coming out. No other account in the entire tax code does all 3. Not one. The HSA stands completely alone. Financial planners call this the triple tax advantage, and that phrase gets thrown around so casually that people stop hearing it. So let me make it concrete. Imagine you earn $1 at your job. Before that dollar ever touches a 401k or a Roth or a savings account, the government has a claim on a chunk of it. But if that dollar goes straight into your HSA from your paycheck, the government's claim simply does not apply. The full dollar lands in the account. It then grows into $2, $3, $5 over the years, and the government's claim still does not apply to any of that growth. And then, when you finally spend it on a doctor visit, a prescription, a surgery, a pair of glasses, a dental crown, the government's claim still does not apply. That single dollar did its entire life's work, and the IRS never took a bite. Run that across thousands of dollars a year for a few decades, and the gap between using this account and ignoring it becomes enormous. We will do that exact math later in the video, and the number is going to surprise you. Here's what you can actually put in for 2026. If you have health coverage just for yourself, the contribution limit is $4,400. If you have family coverage, the limit is $8,750. And if you are 55 or older and not yet on Medicare, you can add an extra $1,000 on top every year as a catch-up contribution. Those limits include anything your employer chips in. So if your company seeds your account with $500 or $1,000, that counts toward the total. Those numbers might not sound life-changing on their own. $4,400. But that is exactly the trap. The amount looks small, so people treat the account as small, and they never see the machine it can become. Stick with me. Secret number 2, the FICA bonus your employer definitely won't mention. This one is genuinely obscure, and it is worth real money. When you contribute to your HSA through your employer's payroll system, meaning the money is taken straight out of your paycheck before you ever see it, something happens that does not happen with almost any other account. You skip the FICA tax. FICA is the payroll tax. It is the money that funds Social Security and Medicare, and it comes out of your check at a rate of 7.65%. You pay it on basically all of your earned income. You pay it on the money you put into your 401k. You pay it on the money you put into a Roth IRA. There is almost no legal way for a regular employee to earn $1 of wages and avoid FICA on it. The HSA, contributed through payroll, is the exception. Money routed from your paycheck into your HSA is not just exempt from federal and state income tax, it is also exempt from that 7.65% payroll tax. Your employer's matching share of FICA disappears on that money too, which is a quiet reason some companies actually like offering HSAs, though they will rarely frame it that way to you. Let me stack the savings so you can see it. Say you are in the 22% federal tax bracket, which is where a lot of middle-class earners land. On every dollar you move into your HSA through payroll, you save the 22% income tax, plus the 7.65% FICA, plus whatever your state income tax is. Fidelity has pointed out that for a worker in that situation, the total saving can come to nearly 30 cents on every single dollar contributed. Think about what that means. You decide to put $4,400 into your HSA this year. Because of the tax you never pay, the real cost of doing that, the actual dent in your take-home pay, is closer to $3,100. The government effectively handed you the other $1,300. And you have not even invested it yet. You have not earned a single dollar of growth yet. You are already up, just from the way the money went in. This is the part the open enrollment slide skips entirely. And there is a small but important catch hiding in here. You only get the FICA break if you contribute through payroll. If you contribute to your HSA directly, by transferring money in from your bank account, you still get the income tax deduction when you file your return, but you do not get the FICA savings back. So if your employer offers payroll contributions to the HSA, that is almost always the better route. Set it up through payroll. Let it come out before the money ever reaches your checking account. Secret number 3, the spending trap. This is the mistake that quietly destroys the account's potential for the majority of people who own one. Here is what naturally happens. You sign up for the HSA. Money starts accumulating. Then you go to the dentist, you get a $200 bill, and you think, well, that is literally what this account is for. So you pay the dentist with the HSA card. Then there is a prescription. Then a copay. Then your kid needs new glasses. And every time you reach for the HSA card, because that is how it was sold to you. A medical account. Use it for medical things. By the end of the year, your balance is back near zero. And next year, the same cycle runs again. Contribute, spend, drain. Contribute, spend, drain. If that is how you use it, the HSA is still mildly useful. You did get the tax break on the way in, but you have completely thrown away the 2 most valuable parts of the account, the tax-free growth and the long-term compounding. You turned a wealth-building machine into a slightly tax-efficient checking account. The wealthy do the exact opposite, and this is the single biggest behavioral difference. They contribute the maximum every year, and then they do not touch it. When a medical bill arrives, they pay it out of their regular checking account or with a normal credit card, even though they have HSA money sitting right there. They let the HSA balance stay put, fully invested, growing, untouched. I know how that sounds. It sounds like you are making your own life harder on purpose. You have a dedicated medical account, and you are deliberately not using it for medical bills. But there is a reason, and once you see it, you cannot unsee it. Every dollar you pull out of that account today is a dollar that stops compounding forever. A dollar left alone in there for 25 or 30 years, invested properly, does not stay a dollar. It becomes $5, $6, $7. So when you spend $100 of HSA money on a copay at age 35, you are not really spending $100. You are spending what that $100 would have grown into by retirement, which could be $600 or $700. You are spending your future self's money to save your current self a minor inconvenience. The people who build serious balances make a clean mental separation. They decide on day one that the HSA is not a healthcare account. It is a retirement account that happens to live under a healthcare label. And retirement accounts do not get rated for a teeth cleaning. Now, I want to be fair and human about this. Not everyone can afford to leave the HSA untouched. If a surprise medical bill would otherwise go on a credit card at 20-something% interest, then yes, use the HSA. Paying a real bill from the account is always better than going into high-interest debt to protect a long-term strategy. The leave-it-alone approach is for people who have enough cash flow to cover routine medical costs out of pocket. If that is not you yet, that is okay. We will come back to what to do in that situation later. Secret number 4. The investment switch that almost nobody flips. This is, in my opinion, the most expensive oversight in this entire topic, and it is invisible, which is exactly why it is so common. When you open an HSA, the money you contribute does not automatically get invested. By default, it lands in what is essentially a savings account inside the HSA, a cash holding account. And that cash account typically pays you almost nothing. A fraction of a percent, sometimes basically zero. A lot of people go years, genuinely years, contributing faithfully to their HSA, watching the balance slowly climb, feeling responsible about it, and the entire time that money is just sitting in cash, earning nothing. They think they are investing. They are actually just parking. To make the HSA do what we have been describing, the tax-free growth, the compounding into six figures, you have to take one more step that the system does not take for you. You have to go into your HSA provider's website, find the investment section, and actually move your cash into investments. For most people, that means index funds, a broad total stock market fund or an S&P 500 fund, the same kinds of low-cost, diversified funds that financial planners recommend for retirement money in general. Many HSA providers require you to keep a small minimum in cash, maybe $1,000 or $2,000, before they let you invest the rest. Fine. Keep that minimum as your medical cushion and invest everything above it. But you do have to log in and do it. The default will not do it for you. The default will leave you in cash forever, quietly costing you years of growth. This is the difference between an HSA that grows like a savings account and an HSA that grows like a retirement account. Same contributions, same tax advantages on paper. Wildly different outcomes, decades later, entirely because one person clicked the invest button and one person never knew it existed. So if you take only one concrete action from this video, let it be this. Log into your HSA after watching. Check whether your balance is sitting in cash. If it is, look for the option to invest it and move it into a broad, low-cost index fund. That single click, done early in your working life, is worth more than almost any other money decision you will make this year. If you are getting value out of this so far, take a second to subscribe. I break down the financial moves that nobody bothers to teach us every week in plain language with the real numbers. Now let me show you the strategy that ties all of this together, because this next one is the part the wealthy genuinely treat like a private trick. Secret number 5, the shoebox strategy, also known as paying yourself back. This is where the HSA stops being clever and starts being almost unfair in your favor. To understand it, you need one specific fact about the rules, and it is a fact that even people who own HSAs usually do not know. There is no deadline on reimbursing yourself for a medical expense from your HSA. None. The IRS places no statute of limitations on it. Let me explain what that actually unlocks. Normally, you think of it like this. You have a medical expense, you pay for it from your HSA, done. Same year, same transaction. But the rules do not actually require that timing. The real rule is simply this. As long as a medical expense happened after you opened your HSA and you paid for it yourself and were never reimbursed for it any other way, you are allowed to reimburse yourself from your HSA for that expense at any point in the future, tax-free, even if the expense happened 20 years ago. So here's the strategy. Starting now, you pay for your medical cost out of pocket with normal money, and you leave the HSA invested and growing. But every single time you pay a medical bill, you keep the receipt. The doctor visit, the prescription, the dental work, the glasses, the hospital bill, the co-pays. You save every receipt and every explanation of benefits. People literally used to throw all of it in a shoebox, which is where the name comes from. Today, you would just scan everything into a folder on your computer or in cloud storage. Now fast forward 20 or 30 years. Your HSA has been compounding untouched that entire time. It has grown into a large balance. And you have a folder, digital or physical, full of years and years of medical receipts that you paid for yourself and never got reimbursed for. Every one of those receipts is, in effect, a tax-free withdrawal coupon. At any moment you choose, you can add up those old receipts and pull that exact amount out of your HSA, completely tax-free, and spend it on anything at all. Think about how strange and wonderful that is. You paid a $400 dental bill in your 30s out of your checking account. You saved the receipt. That $400 of HSA contribution that you would have spent on the dentist instead stayed invested. 30 years later, it has grown into maybe $2,000. And because you still have that 30-year-old dental receipt, you are allowed to withdraw $2,000 tax-free, justified by a $400 bill, and spend it on a vacation, a car repair, your grandchild's birthday, groceries, whatever you want. The receipt is just paperwork that makes the withdrawal legal. The growth in between was all yours, and the IRS never taxed any of it. This is the move advisors quietly set up for their wealthy clients. Max the HSA, invest it aggressively, never spend it, pay all current medical costs from regular money, and keep a meticulous archive of receipts that decades from now becomes a stack of tax-free permission slips. There is one piece of housekeeping that makes this strategy actually work, and I want to be honest that it requires discipline. You have to keep the records. If you reimburse yourself in 2055 for a bill from 2026 and the IRS ever asks, you need to be able to produce that 2026 receipt and show it was a genuine, qualified medical expense that you never reimbursed any other way. So this is not effortless. It is a 30-year filing habit, but it is a 15-minute-a-year habit that protects a six-figure tax advantage, which is one of the best trades on your time you will ever find. Secret number 6, the age 65 pivot. This is the rule that converts the HSA from a medical account into something even bigger. For most of your working life, the HSA has one strict condition attached to its magic. The withdrawals are only tax-free if you spend them on qualified medical expenses. If you pull money out before age 65 for something that is not medical, you do not just owe income tax on it. You also get hit with a 20% penalty on top. That penalty is the IRS's way of saying, this account is for healthcare. Do not treat it as a piggy bank. But something changes the moment you turn 65. At 65, that 20% penalty disappears entirely. Gone. From that birthday onward, you can withdraw money from your HSA for absolutely any reason, medical or not, with no penalty whatsoever. Now, if you spend it on something non-medical after 65, you do still owe ordinary income tax on that withdrawal. So for non-medical spending, the HSA after 65 behaves exactly like a traditional IRA or a traditional 401k. Money comes out, you pay income tax on it, no penalty. That alone makes it a perfectly good backup retirement account. But here is the part that keeps it special. Even after 65, if you spend HSA money on a qualified medical expense, it is still completely tax-free. The penalty went away, but the superpower stayed. So the account you have been building becomes a two-sided tool in retirement. Spend it on healthcare, and it is the best account you own, totally tax-free. Spend it on a cruise, and it is merely as good as your 401k. There is no scenario in which it becomes a bad account. The floor is a traditional retirement account. The ceiling is tax-free money. And in retirement, that medical side gets used constantly because the HSA can pay for things people do not expect. Once you're on Medicare, your HSA can be used tax-free to pay your Medicare Part B premiums, your Part D prescription drug premiums, and your Medicare Advantage premiums. Those premiums get pulled out of a lot of retirees' Social Security checks every month and quietly shrink their income. If you have an HSA, you can cover those premiums with tax-free dollars instead. Over a long retirement, that is thousands and thousands of dollars of premiums paid with money the IRS never touched. There is one specific exception worth memorizing. Your HSA cannot pay for Medigap premiums, also called Medicare Supplement Insurance. Medicare Part B, yes. Part D, yes. Medicare Advantage, yes. Medigap, no. It is an odd little carve-out in the rules, but it matters, so file it away. There is also a timing rule around 65 that trips people up, and it is important enough to say clearly. Once you actually enroll in Medicare, you can no longer contribute new money to your HSA. You can still spend it, still grow it, still reimburse yourself from it forever. You just cannot add to it anymore. And because Medicare Part A can apply retroactively for up to 6 months when you enroll after 65, the common guidance is to stop making HSA contributions about 6 months before you start Medicare or claim Social Security, so you do not accidentally over-contribute and create a tax mess. If you plan on working past 65 and delaying Medicare, you can keep contributing, But the moment Medicare begins, the contributions stop. Secret number 7, the 2026 expansion. This is the freshest part of the whole story, and it is the reason this video matters right now specifically. For the entire history of the HSA, there was one hard gate in front of it. To contribute to an HSA, you had to be enrolled in a specific type of insurance called a high-deductible health plan, an HDHP. If your plan did not officially qualify as an HDHP, you simply could not have an HSA. Full stop. That gate locked out a huge number of Americans, especially people who buy their own insurance through the marketplace rather than getting it from a big employer. In 2026, that gate was rebuilt. A law commonly called the One Big Beautiful Bill, signed in July of 2025, made the largest expansion to HSA eligibility in roughly 2 decades, and the key pieces took effect on January 1st, 2026. Here is what changed. Starting in 2026, if you are enrolled in a bronze or catastrophic plan from the Affordable Care Act marketplace, your plan now automatically counts as HSA eligible, even if it would not have met the old technical definition of a high-deductible plan. Bronze plans are the low-premium, higher-deductible marketplace plans that millions of self-employed people, gig workers, freelancers, and small business folks already use. Catastrophic plans are the very low-premium plans available mainly to people under 30 or those with a hardship exemption. Before 2026, most of those people could not open an HSA at all. As of 2026, they can. By the estimates floating around when the law passed, that change opened the door to roughly 7.3 million Americans who were previously locked out, with the eligible population potentially growing past 10 million as more catastrophic plan holders qualify. If you buy your own insurance, this is enormous. It means the most tax-advantaged account in the country, which used to be effectively an employee-only perk, is now available to a huge slice of self-employed America for the first time. 2 more changes came with the same law. Telehealth, getting care over video or phone, was made permanently compatible with HSA contributions, so using virtual care before you hit your deductible no longer threatens your eligibility. And direct primary care arrangements, where you pay a doctor a flat monthly fee for routine care instead of billing insurance for every visit, are now allowed alongside an HSA, as long as the monthly fee stays at or below $150 for an individual or $300 for a family. You can even pay those direct primary care fees with HSA money. So if you have ever looked into the HSA before and concluded it was not for you because your insurance did not qualify, that conclusion may simply be out of date as of this year. The rules changed underneath you. It is worth checking again. Now let's do the thing I promised at the start. Let's actually build the number. Let's see how this becomes $400,000. The math is not complicated, and that is the point. There is no trick in it. There is no leverage, no risky bet, no special access. It is just contributions plus time plus ordinary market growth multiplied by the fact that the IRS is locked out of every step. Start with a single person who contributes the 2026 self-only maximum, $4,400 a year. Imagine they do that consistently across a working career, and they invest it the way we talked about, in broad, low-cost index funds. Over the long run, the stock market has historically returned somewhere around 7% a year after inflation is set aside, and that is the figure financial planners typically use for these projections. It is not a guarantee. Markets go up and down, and some decades disappoint. But as a planning assumption, it is reasonable and widely used. Run $4,400 a year, growing at about 7% for 30 years. The balance lands in the neighborhood of $440,000. Just the self-only contribution. One person. No catch-up contributions, no employer money added in, no family limit. $400,000 plus dollars, and because it is an HSA, that entire balance can come out without the IRS taking a single cent as long as it goes toward medical costs. And we have already covered how generous the definition of medical costs becomes, especially after 65 with the receipt strategy and the Medicare premiums. That is where the title number comes from. It is not hype. It is just the self-only limit, invested, left alone, given time. And if you have family coverage, the picture roughly doubles. The 2026 family limit is $8,750. Run that for 30 years at the same 7%, and you are looking at a balance well past $800,000. A married couple who treat their family HSA seriously, max it, invest it, never rate it, can genuinely build close to $1 million of tax-free, medically flexible money over a career. From an account that HR described to them in 30 seconds as a place to keep money for copays. Here is why that money is not just a nice number, but a number you will actually need. Fidelity runs an estimate every year of what healthcare will cost an American in retirement. Their 2025 estimate found that a single 65-year-old retiring that year should expect to spend around $172,500 on healthcare across the rest of their life. For a couple, the figure is about $345,000. And that number does not even include long-term care, things like a nursing home or assisted living, which can run far higher. Sit with that for a moment. The average couple is facing roughly $250,000 in healthcare costs in retirement. Most people, when surveyed, guess it will be a fraction of that. They are not budgeting for it at all. And here is the quiet tragedy. They will end up paying that $250,000 out of their regular retirement savings, their 401k, money that gets taxed as ordinary income on the way out. So to actually cover $345,000 of medical bills from a 401k, you have to withdraw considerably more than that because the tax takes its share first. The person with a well-funded HSA does not have that problem. Their healthcare money was set aside in the one account specifically designed so the IRS cannot touch it when it is spent on healthcare. They are paying that $250,000 retirement healthcare bill with the most tax-efficient dollars in existence, while their neighbor pays the same bill with the least tax-efficient dollars in existence. Same retirement, same medical costs, completely different amount of money actually consumed. That is the whole case. That is why advisors quietly call it the secret retirement account. Now, I am going to do something the open enrollment slide never does. I am going to tell you the honest downsides, because there are real ones, and a strategy you only half understand is dangerous. The first downside is the heir problem. An HSA is fantastic while you are alive, and it passes cleanly to a spouse if they inherit it, staying an HSA with all its powers intact. But if your HSA passes to anyone who is not your spouse, a child, a sibling, a friend, the account loses its magic immediately. The entire balance becomes taxable income to that person in the year they inherit it, all at once. So a large HSA is not an ideal account to leave to your kids. The planning takeaway is straightforward. The HSA is best treated as money you intend to spend during your own lifetime, ideally on your own health care. It is not a great vehicle for passing wealth to the next generation. If leaving money to non-spouse heirs is a priority, other accounts do that job better. The second downside is the high deductible health plan itself. For most of the past, and still for most employer situations today, getting an HSA means choosing a high deductible health plan. And high deductible plans are not right for everyone. They have lower monthly premiums, but you pay more out of pocket before the insurance fully kicks in. If you or a family member have a chronic condition, take expensive ongoing medication, or expect a lot of medical care, a high deductible plan can leave you exposed in a year where you need a lot of treatment. The HSA tax benefits do not automatically make a high deductible plan the right choice. You have to look at your actual health situation and run the numbers honestly. For a young, generally healthy person with stable cash flow, the high deductible plan plus HSA combination is often excellent. For a family with significant ongoing medical needs, A more traditional plan with higher premiums but more coverage might genuinely be the smarter call, even though it means giving up the HSA. Do not let the shiny account talk you into the wrong insurance. The third downside is the rules around contributions. And there are a couple of traps. Once you enroll in Medicare, you cannot contribute anymore, which we covered. There is also something called the last month rule and a related testing period. In short, if you become HSA eligible partway through the year and use a special rule to contribute the full annual amount, you generally have to stay enrolled in HSA eligible coverage through the end of the following year, or you can get hit with taxes and a penalty on the amount you overcontributed. The details get technical. The simple version is this: over-contributing to an HSA or contributing while you are not actually eligible creates a tax headache, and the IRS charges an excise tax on excess contributions that linger. So know your limit for the year, know your eligibility, and if your situation is changing, jobs, insurance, Medicare, marriage, it is worth a quick conversation with a tax professional. And the fourth thing is less a downside and more a reality check. This strategy, the leave it invested, pay out of pocket, save the receipts version, only works if you can actually afford to pay your current medical bills with other money. If your budget is genuinely tight, if a medical bill would otherwise go on a credit card at high interest, then the right move is to use the HSA for that bill. The advanced strategy is a privilege of having margin in your budget. There is no shame in using the account the simple way while you build that margin. The tax deduction on the way in still helps you. You just capture the bigger prize later, once your cash flow allows it. I am telling you all of that because I am not interested in selling you a fantasy. The HSA is the most tax-advantaged account available to a regular person. That is true. It is also an account with specific rules, a specific best use, and situations where it is not the right fit. Both things are true at once, and you deserve the whole picture. So let me bring this down to what you actually do. Practical, in order, starting from where you are right now. First, find out if you are eligible. If you get insurance through an employer, look at whether they offer a high-deductible health plan with an HSA, and whether that plan fits your health situation. If you buy your own insurance through the marketplace, check whether you have a bronze or catastrophic plan, because as of 2026, those now qualify. If you are not sure, the next open enrollment is the moment to ask the specific question: does this plan let me contribute to an HSA? Second, if you have an HSA or open one, set your contributions to come out of your paycheck through Payroll if that option exists, so you capture the FICA savings, not just the income tax deduction. Third, contribute as much as you reasonably can toward the limit. $4,400 for self-only, $8,750 for family in 2026, plus the extra $1,000 if you are 55 or older. If you cannot hit the max, that is fine. Contribute what you can. Some is dramatically better than none, and you can raise it over time. Fourth, and do not skip this one, log into your HSA and actually invest the money. Move it out of the default cash account into a broad, low-cost index fund, keeping only the small required minimum in cash as a cushion. Fifth, if your budget allows it, start paying routine medical bills from your regular money and leave the HSA invested. And from this day forward, save every medical receipt in a folder. That folder is your future stack of tax-free withdrawal coupons. That is the entire system. None of it requires a financial advisor. None of it requires being wealthy. It requires knowing the account exists for what it actually is, and then being a little more deliberate than the system expects you to be. And that word, deliberate, is where I want to leave you, because it is the real lesson underneath all of this. The HSA is an extraordinary tool, but notice what kind of tool it is. It is a multiplier. It takes money you were already going to set aside and makes it grow faster and come out cleaner. What it cannot do is create the money in the first place. Every single move in this video, maxing the contribution, investing it, paying medical bills out of pocket so the account can keep compounding, All of it depends on one thing being true first. You have to have margin. You have to have more money coming in than going out, with room left over to fund the account and cover your bills without reaching back into it. That is the part no clever account can hand you. And it is the part almost everyone wants to skip because optimizing a tax loophole feels sophisticated while controlling your spending feels boring. But the order matters. A six-figure HSA is built on top of a budget that works. It is the second floor of the house. If the foundation, your actual relationship with spending, is not solid, the HSA cannot save you. And honestly, neither can any other account. So if you are watching this and a quiet voice is saying, "The truth is my spending is the problem, not my lack of clever accounts," then I want you to listen to that voice. It is right, and it is the most useful thought you will have all week. The people who win with money almost never win because they found the perfect loophole. They win because they got deliberate about what they kept, long before they got clever about where they kept it. If that is where you are, the most valuable thing I can point you toward is not another loophole. It is the groundwork. I made a full guide on minimalist finance, on building a spending life that is calm, intentional, and leaves you with real margin every month. That is the actual starting point of every financial journey that ends well. And it is the thing that makes a video like this one usable instead of just interesting. The HSA is the amplifier. Minimalist finance is the signal. Get the signal right first, and then everything else, the HSA included, finally has something real to multiply. You now know more about the health savings account than the person who explained it to you at work, and almost certainly more than most of the people sitting in that room with you. That knowledge has a real dollar value, and it is yours now. Go use it.